Technologies management itself. In fact, Sajid did have a conversation with the entire top brass. It was a mixed Q4, no doubt, for HCL Tech, with the miss in margins and profitability. More importantly, the FY27 guidance also disappointed, with the company now lowering its revenue growth outlook as well. In fact, take a look at the stock, because that is definitely seeing quite a bit of plunge as we speak right now. 9% lower for HCL Technologies, and that is dragging the entire sector down with it as well. In fact, let's hear out Sajid's chat with the management.
Yes, Q4 became a little lower than our own expectations. Largely, the software business in March was much weaker, and some of the procurement decisions got delayed, and that's really contributed almost 30 million of reduction than what we expected. And that has a direct impact on the profitability as well. Services also came in weaker than what we expected. Even though we met the guidance on the services, 4.8% year on year, it was a little lower than our own expectations due to a couple of telco clients reducing their discretionary spending and a couple of other programs as well. That's broadly the commentary for the last quarter. But having said that, overall, FY26, our business has been very resilient. We've grown 3.9% year on year. And I mean, that's among probably the highest growth among the large scale players. And we feel optimistic about how to deal with AI-led deflation, and how do you really accelerate new services, which are really advanced AI services for us.
You came out with a guidance for FY27 of 1 to 4% on revenue growth, and for services around, if I'm not wrong, 1.5 to 4.5% in terms of growth there. Again, this growth rate is also a little on the lower side for FY27. What all this guidance factors in for you?
Yeah, I think most important is 1.5 to 4.5% on the services business, which is 92% of our overall revenue. And our guidance at the lower end considers the similar softness in the discretionary spending environment. At the higher end, we think discretionary spend will be a little better. Broadly, these are the two contours that we kind of factored in.
Two acquisitions, Jaspersoft and HPE, is that factored in this guidance? And if that concludes in this financial year, what is the kind of upside that's expected?
Yeah, these two acquisitions, while we have announced it, they have not been concluded. They're waiting for regulatory approval. If they get done on a full year basis, it should add 1.5% growth. But we don't expect it to be for the full year because it has not been closed. So depending on when it closes, we will kind of provide you an update.
Okay, let me come to the EBIT margins, down 200 basis points in a quarter where you had a tailwind from currencies as well, currency coming in. What were the factors which led to this 200 basis point decline in EBIT margins?
It's largely because of the softness in the software business we saw. In the services side, the margins were lower by only 27 basis points quarter on quarter. And if you remember that, yes, we did get the benefit of currency by maybe 65 basis points, but that was compensated by a wage hike we gave, and also around 45 basis point impact, and an additional impact of restructuring costs around another 41 basis point, plus some impact of bad debt hit we took in this quarter around 20 basis point, helped by currency as well as the project Ascend, which gave us around 20 basis point.
And what was the kind of wage hike that you took, and what would be the potential impact going into FY27 for that?
So it's we on the back of 80 basis point impact we had in Q3. This quarter is around 45 basis point, and whatever impact is going to have, it's already baked into our forecast for next year, guidance for next year, which is 17.5 to 18.5.
And you're confident to, achieve that kind of guidance given the kind of, headwinds that you're seeing from geopolitical and the macro?
No, I think as we called out, Project Extend is working very well for us. Last year, it gave us around 80 basis point margin improvement, and some of the one-offs which we had last year, which is utilization. We talked about some utilization impact we had, plus slightly lower restructuring costs we are expecting next year. So I think we are quite comfortable with this range of 17.5 to 18.5.
Vijay, you called out about $155 million in AI revenue which came in. And if I'm not wrong, it's a jump of nearly 6% on a quarter-to-quarter basis, on a constant currency basis there. But you're also one of the few to talk about the AI deflationary impact on revenues. How are you managing that deflationary impact? And while other peers are not talking about much, why do you say that there is going to be a significant acceleration also in terms of deflationary impact going into FY27?
No, we are not talking about any acceleration in the deflation. We've broadly estimated, depending on our business, for our business mix, we will see a 2 to 3% deflation for the next few years. And we've been very consciously working on what can we do to offset these deflation with new revenue streams. And that is what the advanced AI revenue streams are, which is AI Factory, physical AI, our IPs and platforms, our inferencing custom chip design capabilities and the services around this. So these are new services that we have launched in the last maybe 4 quarters or maybe even longer. And that is already delivering 620 million of annualized revenue. And we expect this advanced AI revenue to grow at a very strong growth rate, at least 25 to 30% for the next few years. And this will really help offset some of the potential deflation in the traditional services like application development, application support, and some amount of infrastructure and BPO services.
You've highlighted that there are 2 clients, one in the manufacturing and the retail sector, which saw some slowdown coming in, and that hit your Q4 numbers. Do you see those clients going back to normal in FY27, or is this a declining trend for them from a revenue point of view?
We're not sure. I mean, right now they have kind of discontinued these projects. And I mean, they will have to continue it at some point. Whether it will happen in 27 or even later, I'm not able to clearly visualize that at this point.
How are you seeing the orders on the ground from a point of view of? I know most of the orders now have AI inbuilt in them, but from a pricing point of view, is it an aggressive pricing that you're seeing on the ground with many companies trying to get the same revenue pool?
Yes, I think in specific pockets we see it, but there are always right areas where you can focus on, where you can get the kind of pricing that is required to deliver quality services. And that's what we are really focused on.
And how do you look at the North America geography? Are you seeing a sustained growth coming in from that and clients now looking at more engagement and transformation deals which involve AI now?
Yes, barring the couple of things that I called out, North America generally looks robust across a lot of clients across verticals, whereas Europe is looking a little softer. That's what I called out in the yesterday's calls as well.
And from the ER&D space, do you see traction coming in there? Because we've seen a lot of auto companies now talking about slowdown and cut down in production. Is that impacting you as well?
Yes, in FY26, the slowdown in auto impacted us significantly. As you know, we had acquired a firm called ASAP, and we saw a significant decline in revenue in that part of the business. We think it is already bottomed out, and we should see uptick from here. that's our estimate of what's happening in the automotive segment.
Okay, and how do you look at the entire discretionary spend momentum? Has it slowed down, or is it more calibrated at this point in time?
I mean, all through the last year, it has been calibrated, maybe in financial services and technology and services verticals. These two are also fairly large vertical. Almost more than one third of our revenue comes from these two verticals. We see strong discretionary spending, and whereas in other verticals there has been some softening, especially in March, and I guess that will continue at least through the first half of this year.
Vijay, what we are seeing is a once in a decade kind of disruption or transformation for many of the Indian IT companies, and companies like you have seen multiple transformation every decade, and it starts off with a disruption, and then the Indian companies settle in through this process. How do you see this entire scenario playing out? Do you think that companies like you and Indian IT sector are able to manage this transition much better this time, or are we a little slow to catch on to it?
Actually, we have been ahead, unlike other cycles. I think we are all of us recognize that this is a big change, and we need to adopt AI proactively and also look at new services. I feel pretty confident the industry will weather some of the headwinds due to both macro and AI related, and really look at what opportunities are there to grow, and that's what we are focused on.
Is growth going to come in from, Vijay? Because the street seems to have written off the IT companies because of the AI, and Indian IT is seeing more and more of an anti-AI trade at this point in time. Which actually, from a services point, is not true. But how do you change that perception from an industry point of view that tech services is essential part of the AI stack?
Yeah, I think the most important point is we are very critical for enterprises. There are a lot of new technologies which come in, but how do you make them deploy them in real enterprise and ensure that enterprises can get full value from all the promises that the technology promises? I think that is where the true value of a service provider like us comes in. And I think that will get more and more amplified as time goes by. Because right now there is a lot of confusion and people are believing that everything will happen magically. But unfortunately, in a real enterprise, there are a lot of limitations, and service providers play a very key role in landing all these technologies and helping customers scale the adoption of AI. I think that's really the fundamental belief that we have, and that's how it's playing out as well.
As a tech CEO, Vijay, do you see the biggest challenge today being, sustaining this current valuation metrics for Indian IT companies and companies like you? Because when investors look at Indian IT, they look at as very expensive compared to global peers, and that's one of the reasons being the high margins that we enjoy, or Indian IT enjoys. Do you think these margins will continue going forward?
I think, of course, valuation metrics are dependent on multiple things. Of course, growth, also how efficiently you're growing, return on capital employed, and organic growth. All of this has a premium in valuations. And I think that's where India heritage companies are definitely much ahead than the global companies. And I think those are factored in. And I think there is a reason behind all the different multiple variations, I guess.
And from a TCV point of view, Q4 has been a little softer one on a quarter-to-quarter basis. Are there any reasons why it turned out to be soft?
Yeah, TCV can be fluctuating because deal wins cannot be happening in a very predictable manner. Beyond that, nothing else. Overall year, our TCV has remained more or less stable. ACV has increased in spite of some of the deal sizes becoming smaller due to AI-led productivity that's baked in.